Well, joining us for more is Zach Riaz from Banyan Tree Investment. Now, Zach, what did we see overnight? Wall Street ended higher. What was in focus?
Yeah, look, I think tech was in focus. I think there was a news story about Elon Musk coming out, a consortium that includes Elon Musk making a potential bid for OpenAI. I think earnings have been a little bit mixed bag, but what you've seen is obviously since the DeepSeek sell-off, the tech sell-off on the back of DeepSeek, you've seen some of that pull back and investors kind of pile back in. It could be just hedge funds short covering as well and potentially just going long. But overall, that was pretty much the driver on overnight and what we're seeing. I think from our perspective, to be honest, one of the key things is obviously the technology part, which is DeepSeek, but just one step back, inflation expectations. And I just want to share a little chart, which I think is very interesting. Because it shows that, this is a very interesting chart. Just shows inflation expectation. And just keep in mind, there are a lot of hedge fund guys, fundamental guys, that look at charts like this. This is a chart showing basically inflation expectations by Republicans, Democrats, and independents. Now, the Fed perhaps looks at this, hedge funds look at this, fund managers look at this as where markets may be seeing inflation heading. And then accordingly, the Fed may set their policy, and then accordingly, we may set positions in our portfolio. What's interesting is that, for the last 4 years, Republicans found no issue with, the Republicans found an issue with inflation. Suddenly, Donald Trump comes in, and inflation expectation, which is a red line for the Republicans, they suddenly think inflation has gone away. Now, we've all been talking about tariffs and how that may have implication. And then you see the blue lines is the Democrats. For the last 4 years, we know inflation has been elevated suddenly, and they've had no real issues with inflation. And just recently, inflation expectations by Democrats has suddenly gone up. Now, the point that I'm making is that there's clearly an element of politicalization in macro data. And all I'm suggesting for investors, and something we very much focus on ourselves, is sometimes you just got to be a bit mindful of reading data on face value, and you've got to really read through a few, or you've got to really supplement that with a few things. And that's a great example. Where do you take it from there? Do you believe the Republicans or Democrats? So I think that's an important point.
And we will get an inflation read out of
Yes.
the US on Wednesday. So what are the experts expecting there?
Yeah, look, I think I haven't looked at the latest data. What I can tell you is the expectations of a US Fed rate cut has continued to diminish in the US for this year. I think more broadly, inflation is expected to moderate or continue to moderate. I think maybe even plateau. But I can tell you what our expectations is. I think if things continue to hold up from an economic perspective, and China continues to potentially come out of its slumber on the back of the stimulus package, we think there's, and obviously Trump's pro-growth policy, we think there's still upside risk to inflation expectations. So it will be inflation readings in the next 3-4 months anyway. So it will be interesting to see what comes out, but we're certainly in the camp that there's still upside risk to inflation in the US.
Now, we've seen overnight the steelmakers climb on Trump's tariff threats. More broadly, what are you expecting with those announcements that are set to be made either today or tomorrow?
Yeah, around tariffs?
Yeah.
Look, I think we're not making big moves in our portfolios on the back of this. I mean, Mexico and Canada was a great example. They were announced on Friday night. By Monday morning, we had a very cordial conversation with the PMs, and by the next day, there was 30 days grace period until Canada and Mexico, bolstered the obviously borders. Look, I think what we do is we're trying to look at it from a stock-specific issue and a stock-specific bottom-up perspective. And certainly companies like your global multinationals will be impacted. But one thing we've been saying to our clients is, I think, first and foremost, everyone should have been expecting these tariffs. We certainly think it's in large part a negotiation tactic, but nonetheless, certainly CEOs and CFOs should have been expecting this. They've had a previous experience in Trump 1.0 in 2018. So they should be expecting, they should have been preparing in some respects. The second part is, right, obviously the biggest impact will be supply chains, right? Where are your cost bases and where are the tariffs and where are your sell focus? So I think given the COVID experience, a lot of the CEOs have started to become very nimble or think very nimble with their supply chains. So I think that's going to put a lot of CEOs, multinational, in good stead. So depending on how it eventually falls, I think it will have a bit of an impact on margins as the 2018 experience shows. But I still feel that companies, CEOs are much better prepared, and you may be surprised.
And on a different topic, moving into AI, you expect DeepSeek to have the most impact on US markets?
Yes, so that's a bit of a headline grab. Absolutely. But look, I think the conversation right now has been DeepSeek will impact the US market the most. That is very accurate, and this is a great chart. Now, the author of this chart is showing you, basically trying to validate what I'm saying is that DeepSeek will have the most impact. And it shows you the earnings growth in from 2021 by region, so US, developed markets, outside, excluding US and emerging markets, and the forward earnings expectations, earnings growth expectations from 2024 to 2026. And very simply, from 2021 to 2024, 63% of earnings growth in the US were led by artificial intelligence, right? AI. Going forward, it's actually much less. It's actually only 48%. Now, so in very simplistic terms, this chart is showing you is that, sure, the US absolutely stands to be the most disrupted from any competitors emerging like DeepSeek in Asia or other parts of the world. But look, let me flip this on its head. And I think it also shows you the strength of the US markets. 48% of future earnings in the US is still driven by AI. Call it innovation. Whereas developed markets outside of the US, only 12%, emerging markets, 9%. I think that's a real strength. I don't think innovation is going to stop. And if you look at the tech companies that have reported, they're still actually spending a fair amount of capex. So whilst the author of that chart may have shown it, hey, the US is most risk from the disruption from DeepSeek like DeepSeek competitors, I think it also just shows you the level of innovation that's happening in the US, and don't discount them, because whilst emerging markets, China may be able to reinvent some of the innovation that's coming out of the US is still coming up with the original ideas.
And Zach, coming back home now, you have screened the ASX 300.
Yes.
And you say that there are some sectors that you're wanting to avoid at the moment.
Yeah, look, we do this on an annual basis, and we run obviously a dividend strategy in Australia. As you are very well aware, Australian investors love the dividend. One point I'll just make, when we ran this same screen last year, and I'll tell you what the screens are, we had about 15 stocks. We've got about 9 stocks now. And if you look at the bottom, ASX 200, it's trading on a forward P of 20 times, yield of 3.4%. The average yield for ASX is nearly around 4.3, 4.5%. So first inference that I would like to make is the market has run so much, the multiple has expanded so much, even for the Australian market, there are not too many genuine yield. And so look, just to quickly, the screens that we ran, at least a yield of 4%, and it must be, as rated by consensus, and must be growing year on year. So it can't be going backwards. It can be flat, but it needs to be at least 4%. We're avoiding real estate right now. Not that we're particularly against real estate, but I mean, office is still a bit of an issue. High interest rates is still potentially an issue for cost of capital. And then we've also avoided banks in this list. So, I mean, banks are already well owned by Australian investors already, so there's no point doubling up. The other thing we considered was high ROEs, so minimum ROEs at least of 15%. One thing highlighted in the green, I think doesn't get enough attention, is companies earning well above their cost of capital. So ROIC is just simply your return on invested capital minus the cost of capital that you had to pay to deliver that. And I think there needs to be a good buffer. High quality companies tend to have a decent buffer. So what's that basically showing you is two things: that there are limited options now since the return of, since the re-rating of PEs. There's not too many dividend options. And the one that I'll call out from there is Macmillan Shakespeare. giving you a yield of 10.2%. Trading on 9 times, there's some deep value there. That's MMS. Novated Leases, I think it's going to deliver half decent returns in the upcoming results, and I think it's the back half of February. We like the market. The car sales market has been a little bit weak, and EVs has taken a bit of a shine off as well. But nonetheless, at 9 times PE, 10 times yield, it's got pretty strong market positions. I'd say we take it.